What's up, everybody? It is Tuesday, July 26th. Market pulling back again today. I'm going to talk about that. But first, I want to talk about an op-ed that appeared in the Wall Street Journal today. A friend of mine sent it to me. And the reason why I'm going to talk about this op-ed is because it basically echoes something that I've been telling you guys for a long time. In fact, I've been talking about this at least going back to 2016, if not earlier. I remember because when I was writing articles for thestreet.com back then, I wrote about this very thing. And what I'm going to talk about is, you know, how I've been saying that the Fed, by raising interest rates, it's literally raising the burden or the interest on itself, because the Fed has to pay interest on reserves. So like the higher it goes, the higher the rate goes, the more money the Fed has to pay as interest on those reserves, and it pays it out of its own earnings. And I said there's going to be a threshold, there's going to be a level where the rate of interest is going to cause the Fed to be on the hook for more than it earns on its portfolio. And we're there. Basically, you know, a 2.25% Fed funds rate, which we're going to have tomorrow, on, you know, $6 billion in system reserves, or like $5.8 billion. You know, you're talking about $130 billion in interest that the Fed has to pay on those reserves, and it only earned like $116 billion last year, of which, you know, 93% of that it remits to the Treasury, and it just keeps you know, the remainder for its own operations. So today in the Wall Street Journal, this economist Judy Shelton, maybe some of you are familiar with Judy Shelton. I think she's kind of a wacko economist, because she's like a die-hard gold bug. And it's really hard nowadays to find any mainstream economists. And I say mainstream because she was actually nominated by Trump to be on the FOMC. But she withdrew her nomination when, you know, it looked like it wasn't going to happen. I mean, she was just too far out there. But she wrote this op-ed, and I'm going to put up a screenshot here of a quote that she had in it. I'm going to read it. She says, "The tricky situation the Fed now faces is that its own net interest income, $116.3 billion in 2021, of which 93% was remitted to the Treasury, will soon be exhausted by the higher interest rates it intends to pay on those combined cash funds." So, if you follow my channel here, like, I don't know, like, I hardly have any viewership when you think about it. Look at my views. Like, they're in the hundreds. They're not even in the thousands. Like, the stuff I tell you guys, the education I bring to you, like way before it becomes kind of like mainstream. Like here's an op-ed in the Wall Street Journal where she's, you know, Judy Shelton is basically echoing things that I've been saying for 6 years. I'm sure I did a lot of videos on this. Never mind, you know, contributions to thestreet.com, which I don't do. I don't write for them anymore. But I don't know, man. I just I have very little viewership. But I'm not saying this to cry about my viewership. I'm just saying, like, I'm bringing you guys information that you're really not seeing anywhere else. And by the time it comes out, you will have heard about it here way before it comes out into the mainstream. So there you go. And she says in the op-ed, actually, she says soon the Fed's funds will be exhausted. They're going to be, as of, you know, tomorrow, they're going to raise rates by 75. That'll put their target rate at 2.25 to 2.5. Like I said, there's like 5.8 trillion in system reserves. So that's a minimum of 130 billion they got to pay out. And they're just not making that money. Now, She goes on to say, I believe, because I did not read the article myself. I don't have a subscription to the Wall Street Journal. I don't read the Wall Street Journal. But anyway, my friend told me that she said the Fed will be running on negative cash flow. It's going to have to go to the Treasury. See, let me backtrack a little bit. And for those of you who understand this, you know, if you've been listening to me talk about this for a while, it was Ben Bernanke back in 2008 who asked Congress for the authority to give the Fed the authority to pay interest on reserves directly. Prior to 2008, it was the Treasury, the U.S. Treasury directly that paid interest on reserves. And that was a situation where, you know, the Treasury can always pay. The Fed, on the other hand, it has to pay out of its earnings. So this goes back to Bernanke. It was his brilliant idea, and I say that facetiously because he obviously didn't, you know, kind of think ahead. Like, what happens if the Fed gets into one of these aggressive rate hike cycles like what they're in now? And maybe Bernanke thought, hey, you know, we'll just keep rates at zero, but which would be the right thing to do, frankly, like the Bank of Japan. The Bank of Japan, by the way, has shown itself to be the only independent thinking and understanding of its status as a monopolist. All the other central banks in the world are caving in and raising interest rates. So I just thought this was an interesting comment, but yeah, so anyway, it goes back to Bernanke when Bernanke asked Congress for the authority to pay interest on reserves directly. So now the Fed's on the hook for this. Now, what I was going to say was that the Fed seems to be, and I'm not 100% sure about this, but I recall some comments that were made by Fed officials last month when this issue started to pop up again. And the Fed, the comments that I read was that the Fed has a strategy for this. What they're going to do is they're going to credit deferred income from deferred assets, or deferred income from future assets. They're going to credit in the current period, and that's how they're going to make this work, okay? So they're basically going to book entry income that they expect to receive in the future. They're going to credit it in the current period, and that's how they expect to, hang on, FDNY, New York's bravest. So yeah, we'll see what's going to happen. But, you know, I just wanted to bring this to your attention because, again, you get this stuff here first. You don't get it anywhere else. The stuff you get everywhere else, I watch some of these financial YouTube channels, and it's just like the same old thing. It's like it's either die-hard monetarism or hard money Austrian stuff, and it's just, frankly, I find it to be useless. I don't know, but they get thousands upon thousands of views. All right, let's talk about the market. First of all, let me mention that yesterday was a pretty big fiscal liquidity drain. And, you know, we haven't seen a lot of those this month. I think I said there were only something like 3 so far. I think this might be the 4th one this month, but last month in June there were 11 days. That's like more than half the month because there's 20 business days in a month. 11 of those days saw individual days of fiscal liquidity drain. Yesterday we had a pretty big one of like 16.8 billion. So I'm not surprised. Hang on. I'm not surprised that the market, I mean, it was down. Well, we were mixed yesterday. The Dow was up, S&P was up, NASDAQ was down. I'm not surprised that we followed through on a down note today with that liquidity drain. The good news is tomorrow is a Social Security payment, And, you know, that's usually like a 24 billion net fiscal addition. Wow, something's really going on here. So I'm pretty sure tomorrow we're going to see, well, let me put it this way, because tomorrow is the Fed meeting. They're going to raise rates. It's going to be a lot of volatility. So I would say, absent the Fed and the volatility that is going to create, and let me just explain, that volatility tomorrow, that's going to be pure headline trading, okay? I will offer this. If the market pulls back tomorrow based on whatever, you know, the Fed says or does, you use that as a buying opportunity. By the way, I bought some oil stocks today. I keep doing what the producers are doing. Every time the market is down, you see them loading up on futures. I've been buying oil stocks when oil's down and when oil stocks are down, so I did that today. So look for, we're getting a positive liquidity flow tomorrow. Wow, something is really going on here. A lot of fire engines. Man, I think it's right outside, to be honest with you. Hey, if you start seeing smoke coming up in back of me, let me know, man. I might have to get out of here real quick. What else I want to say? Yeah, so that's it. I mean, I don't, you know, the pullback that we've had yesterday and today, that's coming right down into some pretty good support. I see the fiscal now as positive. As I've been telling you guys, we're seeing the deficits start to widen out again. That's good. That's a net addition to the financial balances of the economy, of the non-government. That is good. That is positive. We want to see that, and that is happening. Also, the other thing that I mentioned yesterday, which, I don't know, maybe it's too early to call this. I'm keeping a close eye on it. It looks like, possibly, that tax flows are starting to slow down. And I explained that yesterday because you might say, well, isn't that bad? If tax flows are slowing down, it's a sign of a weaker earnings, weaker economy. Yes, but on the other hand, you know, this has been part of the problem. The tax flows have been resulting in net drain. We need the pool to fill up. We need the swimming pool to fill up. So, and I think that's starting to happen now. So that is a good thing. Anyway, that's the update for today. I'm sorry for all the interruptions, but hey, it's FDNY. Got to stand by those guys. New York's bravest. Take care. Bye.